All right, today we're going to try and decode a pharmaceutical giant, AbbVie. Now, if you've ever looked at a company's financial report, you know it can be, well, a lot. But don't worry, we're going to cut right through the noise using a simple but really powerful framework from one of the greatest investors of all time.
You know, when you first pull up the numbers for a company, it can feel just like this, an absolute wall of data. PE ratios, debt to equity, free cash flow. It's enough to make your head spin.
And that's the million-dollar question, isn't it? With all this information flying at you, how do you figure out what actually matters? How do you find the real story of the business that's buried in that spreadsheet? Well, to slice through all that clutter, we're going to borrow a few key ideas from the man himself, Warren Buffett. We're going to use his value investing principles as a kind of X-ray vision to see what we can really find out about AbbVie. So think of this as a quick health checkup on the company, inspired by what Buffett looks for. We're not going to look at everything, just a few critical vital signs to get a clearer picture. Here's our game plan. It's a simple 3-point checklist. 1. Is this a profitable business with a real competitive advantage? 2. Does the company treat its shareholders, the owners, well? And 3. Is it trading at a fair price? That's it. Simple but powerful.
Okay, let's dive into that first point. We're on the hunt for signs of a super profitable business that has a durable competitive advantage, what Buffett famously calls a moat.
And whoa, right off the bat, we see something pretty remarkable, a return on equity of over 128%. I mean, that is an incredibly high number. It's a huge first sign that AbbVie is a seriously profitable business, generating a ton of profit from the money shareholders have put in.
Next up, we've got return on invested capital, sitting at over 13%. Now, this number gives us a wider look at profitability because it includes debt. A number like this, when it's consistently high, often suggests the company has that moat we were talking about, something that protects its profits from competitors.
But here's where the plot thickens a bit. You can see here that while their revenue has been growing a little bit over the last 3 years, their net income has actually dropped quite a bit. And that makes you ask a really important question. Is that amazing profitability we just saw actually sustainable?
Okay, on to our second checklist item. It's great if a business is a moneymaker, but does it actually share that success with its owners, the shareholders? One of the best ways to tell is to look at the dividends. And right away, we see a really clear commitment here. AbbVie has increased its dividend payment for 14 years in a row. That's a pretty powerful signal that management really cares about returning cash to investors, which is a big green flag in this kind of analysis. But can they actually afford to keep this up? I mean, look at this. It's kind of confusing. The payout ratio based on earnings is a scary-looking 284%. That makes it seem like they're paying out way more in dividends than they're making in profit. But then, the payout ratio based on free cash flow is a much more reasonable 66.88%. So, what's the deal here? Okay, so here's the key. You gotta understand the difference. A company's earnings can be pushed around by all sorts of accounting stuff that isn't actual cash. Free cash flow, though, that's the real cold hard cash the business has left over. That's why a lot of people think the free cash flow payout ratio is a much better way to see if a dividend is safe. And at under 67%, AbbVie's dividend looks pretty secure from a cash standpoint. And that brings us to our final and maybe most important piece of the checkup. Buffett has a famous saying, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This is all about finding a margin of safety. And this slide just lays it all out. The stock was recently trading near $199 a share. But a valuation model using its free cash flow estimates its fair value is closer to $189. So, since the price you'd pay is higher than the estimated value, we get a negative margin of safety. Basically, this suggests the stock isn't on sale right now. So let's recap. We've gone through our 3-point checklist, we've found some really impressive strengths, and we've also uncovered a few potential red flags. Let's just pull it all together and see what our quick Buffett-style analysis is telling us.
Okay, so on the plus side, we've got a history of great returns for investors, a dividend policy that shareholders love, and really strong signs of a profitable business with a solid moat. But on the other hand, there's that recent dip in net income, that confusing earnings payout ratio, and a valuation that suggests the stock might already be a bit pricey. Now, this isn't investment advice, of course, but it is a really fascinating snapshot. And that really brings us to the final thought here. A checklist like this is a fantastic tool for cutting through the noise, but it's only the beginning of the story. It doesn't tell you about the company's new drugs in the pipeline, or how good its management team is, or what might happen when its patents expire. So it leaves us with a big question. What's the most important part of the story that you just can't find on a spreadsheet? Thanks for tuning in.